that, I hit the volume button by mistake. Go. Let's get rid of that. Let's get rid of that. Are we good to go? We are live on Facebook, LinkedIn, YouTube, X, Instagram. Let's put Ion on pause, and I think we're good. Welcome, everybody. Hi, Ashley. Thank you for joining us on Instagram. It's Monday morning, Monday, November 4th. Can you believe it's November 4th? Where I live, it is snow already. There was a post this morning on my social media about avalanche risk here in the mountains, and it's November 4th. Episode 297. Welcome to Mornings with Scott, the best damn business show for medium and small businesses on the planet. I think our volume is probably good. Ashley says the sound is great. Thank you for that. According to Yahoo Finance, by the way, only one more sleep until the election. How exciting is that? Wow, I'm going to be in the air tomorrow. I'm going to miss a bunch of it, but then I'll be landing in Toronto because I'm coming out to see my peeps in the East, and it's going to be interesting. I'll watch that from the hotel. According to Yahoo Finance, mental health is emerging after a long-standing silence in finance. For decades, personal struggles were pushed aside, considered irrelevant, or worse. Yeah, they were made to seem like a sign of weakness. The writing on this article is horrible. But as workplace losses due to burnout, absenteeism, and lower productivity add up, Wall Street firms are starting to pay attention. Do you believe that? Yeah. The numbers are staggering, and the conversation is shifting. Nearly 1 in 5 U.S. workers rate their own mental health as less than good, according to a recent Gallup panel. The resulting unplanned absences are estimated to cost the U.S. economy nearly $50 billion each year. Sean Lesser knows the stakes all too well after spending decades in the world of private equity. He suffered a mental breakdown in 2022 during an investor call that led him to rethink everything. He founded The Real, REAL. He founded some organization called The Real, endowing it with a mission to, quote, to build a community to support and foster the mental health and well-being of men across the globe, end quote. His story mirrors a broader problem in finance where high stress, long hours, and competition can take a heavy toll. His breakdown didn't happen overnight. It was not unique. Quote, mental health doesn't discriminate, end quote. He says some of the richest people have the most problems. Yeah, they do. It's really quite shocking. But maybe there's a cause correlation issue there. Do you ever think that it's the mental health problems that drove these elite performers to become elite performers and so successful? Think about that. As the financial toll of mental health challenges, they add up. Employers are listening. Companies starting to invest in worker well-being, not just as a form of goodwill, but as a strategy. Healthier employees mean more productive employees, which means more profit. So this is my industry. I find this interesting. Back in the day, and for me, that was late 80s, 90s, even into the 2000s. We didn't think about mental health at all. That was not a conversation, and it would have been a sign of weakness. Nobody would talk about it. I spent my whole career in that industry and in that environment. All of my peers were in that industry and in that environment, and I just can't think of anyone ever having that conversation, admitting to anything. But on the other hand, we just all drank. We just drank heavily, and for some people, it didn't end up that well. It was always my goal as a young professional. I would look at the guys who, to me, seemed old back then, like 40 or 45. They just seemed ancient when I was much, much younger and starting my career in corporate finance. And I would look at these people. I think, wow, that guy's just a drunk. I don't want to turn into that. So I always worked really hard to try and monitor that. Fortunately for me, I hold my alcohol really well. I'm not saying there's no consequence to it, but I've had a strong constitution when it comes to substance abuse. So I deal with that well. And unfortunately for me, maybe I like it a lot, But also for me, it was just part of the job. For everybody, it was part of the job. I used to make all my money just wandering up and down Bay Street, which is the Canadian Wall Street, and drinking. That's what everybody did every night to raise money. I can't seem to get my shirt the way I want it on camera here. And so that's what we did, but we didn't talk about mental health. But obviously that was the issue. That's how we messed it up. So I think it's an interesting conversation. I think it's an interesting shift in the thinking of this industry and presumably other industries that require all the stress and time commitment, and that everybody's searching for balance and health. But here's the counterpoint of view: is my father used to tell me from a very, very young age, balance is bullshit. He always told me that. Is that healthy parenting? Who knows? He used to tell me balance is bullshit. You choose to do this or you choose to do that. I think Gary V has that in his content as well. Gary Vaynerchuk, you can go check it out there. Can't hear that from my father, but you can hear it from Gary V. You're making a choice. If you choose to go for a walk in nature, for an hour, you have chosen not to work for an hour, and you're going to lose to somebody that chose to work for an hour. And you need to be okay with that decision. What you need not to do is to delude yourself into thinking that you have some sort of elusive balance. You do not. Balance is bullshit. If you choose mental health time, you choose to not be productive, and that's okay. You need to make the right choice for your mental health or for your productivity, whatever you're valuing more at that particular point in time, depending on your life circumstances. And that changes over time. Like for me, when I was young in my finance career, I was never an early riser like I am now, but I would show up 8:30, 9 a.m. downtown Toronto in the tower, and I would work. I would work till 1 a.m. or 3 a.m. from say 9, like 9 to 1, or even 3 sometimes, consistently, like at least 6 days a week for years and years. I did that. And then I left and I started my own business, and it was way worse. It was way worse. I worked more. I did an average of 3 all-nighters a week for years. That's what I did. And I brought in a partner named Duke. You should always partner with a guy named Duke. That's my rule of thumb in life. And he was much older than me and came out of Wall Street and some of the major investment banks and trading houses. Was managing director at some of them. I guess I won't drop names, but he came out of that, and he bought half of my firm, and we worked together for years and did very well together. And he, as say probably somebody who was 15 years older than me at the time, was doing 3 all-nighters a week as well. Like he was on it because he grew up in that environment. That is what it takes to succeed in entrepreneurialism, in managing and owning your own business, and in the career of finance, and in the career of many, many other professionals as well. So my problem with this whole discussion of mental health conversation in these vocations is the demand in the vocation is 24/7 dedication. That's what it requires. So what people want is they want the upside. They want the rewards, but they don't want to pay the price. That is what this discussion is about. The average pay in private equity, where this guy came from, I saw a stat on this on the weekend, is over 7 figures. So the average earnings in private equity is over $1 million. Now, I know that's not in small town, in the Midwest, or in southwestern Ontario. I know that's a New York number or Miami number, and it's not for everybody. There's, you start out at a lower number, and some people are making way more than that, but the average is over $1 million. That's why you do the work, to get that reward. So why do you get paid that much? I just think the younger generation never stopped to think about that. They think they're entitled to it. Do they think that they get paid over $1 million a year to build the best financial model? A lot of people can build an Excel spreadsheet. A lot of people can use current technologies and do research and forecast things and write. You don't get paid $1 million for that. Do you get paid $1 million to be the smartest gal in the room? Is that why you get paid $1 million? No, that's not why you get paid $1 million. You get paid $1 million every single year for winning. That's what it's for. It's winning. And winning requires complete dedication, every ounce of your energy, because winning implies competition. And the person at the cubicle next to you or in the office tower across the road is giving that dedication. And if you're not, you're going to lose, and you get paid over $1 million to win. The job requires, and what you're paid for is the ability to handle the hours and the incredible stress. That's what it is. That's what you're paid for. So if you can't deal with that, which is completely fair, it's completely fair that you cannot deal with that, or why would you want to deal with that? Maybe no one in their right mind ought to be dealing with that, but that's the point. Maybe these people are not in their right mind. Maybe I'm not in my right mind. Maybe that's why we got into this profession to begin with, because we love doing that. And that's why we survived. And that's why we succeed. But you have a choice. Don't do it. Just don't work there. Don't be a number one, as Gary Vaynerchuk would say. Be a number two. Being a number one is not for everybody. Having the responsibility of having to win is not for everybody. Some people are just good workhorses. They enjoy their role. They don't have the same mission, the drive, the why that goes along with this, and they just want to do their thing and go off and enjoy other stuff in life, and that's totally cool. But you can't have both. You can't, because balance is bullshit. You can't have both. You can't say to yourself, well, I want to make this $1 million, but I don't want to put the effort in. I don't want to have the stress. The $1 million is for the stress and for being able to manage that. So, by the way, so you have another choice. You don't have to work there. But by the way, have you ever hung out with a professional athlete, right? Elite performers in a different context outside of business? Professional athletes, to a large degree, are a mess of mental health issues. The ones that succeed are the ones that can perform under pressure, under stress. It's not for everyone. Not everyone has the mentality. There's all sorts of talented people in every sport who never became successful as pros in that sport. Why is that? Because they can't perform under pressure. I was a professional athlete, not a great one. I didn't have that much talent, but I was a professional athlete before I went into corporate finance, into that world. And I think the growing up as a kid and competing at very high levels through my whole life taught me to deal with those levels of stress. And I think that's what has worked for me in my career. All right, let's move. Actually, one thing before we move on, a little prediction for you. This is not in the Yahoo article, but I'm gonna predict this right now. You can mark it and you can come back to me later. There will, 5 years from now, be a research study related to mental health. And what it's going to say is that working from home is a huge driver of mental health problems. It removes young professionals, young workers from the team environment, from the peer environment where you could support each other, and you get guidance and a purpose and a mission from the people that are senior to you. You work at home, you lose all of that. There's no way to do that remotely. And I promise you, there's going to be a study that says work from home has been a serious mental health contributor. Hey, thank you for joining us from Lizard Creek Lodge over there. Good to hear from you. All right, Corus Entertainment. We've talked about this a bunch, but another article on this, Wall Street Journal. Canadian television company Corus Entertainment is working with Jefferies Financial Group, that's an investment bank, to explore a sale of its business, according to people with knowledge of the situation. How do you sell an insolvent company that is worth less than the debt, right? The debt is $80. Sorry, the debt's $100, and the whole value of the business is $80. What are the shares worth? Well, negative 20. Okay. And so how do you sell that business? There's only one real way, and that is through a restructuring, a CCAA restructuring in Canada, Chapter 11 in the US. CCAA stands for Company Creditors Arrangement Act. And so, like I've been telling you for a couple of weeks now, it is going to seek bankruptcy protection. That's the only way to deal with this. It's doing so less than 4 months after warning investors that its debt issues, quote, may cast significant doubt about the company's ability to continue as a going concern. The company has been telling you that they cannot continue. Plans are in the early stages. They've hired some bondholders. Jeffries declined to comment. The bondholders hired Canaccord and Bennett Jones, probably graph shop there. Anyways, they hired a law firm and investment bank, and so that's happening. Last week, we talked about Corus cut their line of credit in half in exchange for extended covenants with, it's not in my notes here, but RBC and TD, as I recall. And some analysts have written that the current shareholders may be left with nothing after a restructuring of the company. No, not maybe left with nothing. 100% guaranteed to be left with nothing. That's why we've been talking about it on the show. What is a restructuring? Is taking the value of the company, like in my little example I just gave you, $80, and it is giving that money once it's realized and you're liquid on the $80, giving it to the stakeholders in order of thy priority. The priority order is secured creditors, second lien creditors, unsecured creditors, and very, very last are the shareholders. They've told you the shareholders are going to get nothing. Yet this morning, the Corus stock was up 5%, something like that. It's not a lot, but people are still buying this stock because they think they could take a flyer on this. I promise you, they're going to get burned. There's going to be a cease trade order from the Securities Commission because there's going to be an announcement of a restructuring, and the stock will be cease traded. And then you're going to think to yourself, man, I hope that opens up soon so I can liquidate this position. It will never open up again. That's the pattern over and over again. Remember, I am neither qualified nor registered to give you financial advice at that sort of personal securities level. So don't listen to me. Listen to me on your business. Listen to me on general concepts. But if you are looking at that stock, go talk to your financial advisor before you do anything. Don't listen to me, but I'm just telling you what the pattern is. This is what's going to happen. It has a $23 million market cap this morning with volume. People are buying and selling this stock. Wall Street Journal also reports that Warren Buffett's Berkshire Hathaway sold more Apple stock in the third quarter. So it ended September with $69.9 billion of Apple stock, according to its quarterly report. So they sold about 25% of their holdings. They sold about 400 million shares. Such big numbers. And even after the sale, Berkshire is still Apple's largest shareholder. And this year, they've slashed their position, though Buffett continues to praise the company at his May shareholders meeting. He said that Apple was an even better business than American Express and Coca-Cola, two companies that he loves a lot, and hinted that either selling a position to pay tax. Do you believe that? Do you think they're selling a position to pay tax? Chris Bloomstrom, President and Chief Investment Officer of Semper Augustus Investments, who appears to be a Berkshire guy, invests a lot in Berkshire, has said that he expected the company would disclose this to continue to sell Apple. So he just thinks it's going to sell down. He says the stock is way too expensive, that Apple traded late this week at roughly 30 times its projected earnings. That is, I looked this morning, it was 35 times projected earnings. And the 10-year average is 20 times projected earnings, which, by the way, is a weird metric. It would be historical earnings, not projected earnings that normally you're applying things to. So we'll talk about multiples in a second here. Berkshire's mountain of cash grew to a record $325 billion. That's the cash they have on hand. So again, do you think they're liquidating to pay for tax, or do you think they're liquidating for some other reason? Let's talk about that as well. They posted net income for the quarter of $26.3 billion. Just crazy size numbers, and operating earnings, which excludes some investment results, fell to $10.1 billion from $10.8 billion because of weaker than normal insurance earnings and Hurricane Helene. The company said it further, okay, whatever. Buffett said that operating earnings are, this is important. We're going to talk about this as well, that operating earnings are the better measure of Berkshire's performance. Accounting rules require the company to include unrealized gains and losses from its investments in net income. So a rally or pullback in the stock market can obscure the results of the business Berkshire returns. So what he's basically saying is, when you're looking at generally accepted accounting principles and the way our financial statements are prepared, it's hard to really understand the business. So I want to talk about that a little bit too. Let's start with multiples and growth. What is a multiple of earnings? What is the difference between a 20 times earnings multiple, a 30 times earnings multiple, a 10 times earning multiple? Well, here's the formula. I should have put it in the notes and I didn't, but it's simple to understand. Your multiple is equal to 1, the number 1, divided by your required rate of return minus growth. That's it. So your required rate of return minus growth, and you divide that, you take 1 divided by that equation. Okay, and your required rate of return, or your weighted average cost of capital, if you want to substitute in for that, is really a function of how much, what is the risk-free rate of returns plus an equity premium, because you're not investing in a risk-free rate of return, you're investing in equities, which is not risk-free, like Corus, okay? And then a company-specific premium above that, but that's too complicated for this particular live stream. Just know that there's a required rate of return minus growth, and what we want to focus on today is growth. So let me give you an example. Let's say you have $1 million in earnings. By the way, I talked last Friday on the live stream, or Thursday. I started to talk about growth and how that impacts multiples, and then we didn't get to it, and I promised to come back to it. Well, that is what we're doing right now. Let's say you have $1 million in what we would call in the valuation world normalized earnings, meaning this company, this little private company, is going to bounce around and earn $1 million per year sustainably, like forever into infinity, more or less. Okay, that's your idea. And let's say you've decided that your weighted average cost of capital, which people in the business would call a WACC, or the required rate of return. Remember, the formula is 1 divided by required rate of return minus growth, with brackets around it. So you do that first, and then you do 1 divided by what you're left with. So you have a 15% rate of return requirement with no growth. So what is the multiple? Well, it's 1 divided by 15%, 1 divided by 0.15 is a 6.67 times multiple. That's what a multiple is. The multiple is the inverse of that discount rate of that formula. So 1 divided by 15% in this case gives you 6.67 times multiple. Now, what if your WACC, or your required rate of return, is not 15%? Again, it's beyond the scope of this to try to figure out what that rate of return is. But let's say it moves from 15% to 20%, which for your small and medium-sized business is a much more realistic number. In fact, it could even be 25%. And if you're a startup, it's like 30, 40, 50%. But let's say it's 20% rather than 15%. Well, now you're 1 divided by 20%, 1 divided by 0.2 is a 5 times multiple. So that rate of return moving from 15% to 20% decreases the multiple 6.67 down to 5. Make sense? Okay. Now, what if we said, yeah, it's going to make $1 million forever, but that $1 million into infinity is going to grow at a whopping 10% per year. So next year, you're going to have 1.1 million in earnings, and the year after, you're going to have what would that be? 1.21, whatever. I can't do this off the top of my head early in the morning for me. But the point being, it's going to grow at 10% forever. So we've mathematically introduced G. We've introduced growth to this equation. So what is the multiple now? So at no growth and a 20% rate of return, it was a 5 times multiple. Well, now what you're doing is 1 divided by 0.2 minus 0.1, or 20% minus 10%, because your growth is 10%. So 20% minus 10% is 10%. So it's 1 divided by 10%, 1 divided by 0.1 is a 10 times multiple. So it used to be a 5 times multiple with no growth assumption, and now it's a 10 times multiple with a growth assumption. Okay, so the point being that growth has a massive impact on the multiple. And this is important not just for investors, although it's really important for investors to understand what is going on in today's tech world, but also it's important for you, small, medium-sized business owners, because if you want to increase the value of your business, what should you be focusing on? Yeah, you should have a higher baseline earnings, more than $1 million. Yeah, you should reduce the risk of your $1 million so that you get a lower rate of return or higher multiple. But what you should really be focused on is a track record of sustainable, constant growth. It does you no good at all to have a higher earnings and no growth. It does you some good, but not the bang for the buck that you're looking for. It does you not as much good to have stable earning like the $1 million, but with a growth factor that's really large one year and then negative the next year and then large the year after or negative year after. That's not sustainable, consistent growth. You get your valuation from the sustainable, consistent growth. So when we added the 10% growth year over year into infinity to our multiple, to our equation, we went from a 5 times multiple to a 10 times multiple. What if it was 15% growth instead of 10%? Well, now you end up with a 20 times multiple. You end up with 20 times multiple because you are the 20% rate of return minus the 15% is 5%. So your 1 divided by 5% is a 20 times multiple. Okay, so just going from 10% to 5% growth assumption takes you from 10 to 20 times. Now, think about that. Huge influencer of the growth on valuations, and apply that to tech companies that have been growing tremendously. The article, the Wall Street Journal, told us that Apple was trading at 20 times historical, 20 times earnings historically. Well, average, I looked it up this morning, the average annual earnings growth for Apple over the past 10 years is approximately 15.9% per year. Remember I said that a 15% growth rate translated into a 20 times multiple on our little hypothetical example? Well, here you go. Apple was trading at 20, and they had growth over the past 10 years, averaging 15.9%. So if you're an analyst, one of these $1 million mentally health stressed out analysts, and you're building a financial model, what do you assume the growth is going to be into the future? You just say, well, on average, the last 10 years, it's been close to 16%. I'm just going to put 16% in. And what does it do to the valuation of the stock? Makes a huge difference. Now it's trading at 30 times, it says in the Wall Street Journal article, 30 times earnings. Why? Because growth is slowing. It's projected earnings, so growth is slowing. And when all of these tech companies last week did their earnings releases, they were fantastic, almost across the board, almost universally, but every one of them said, but growth is slowing, growth is slowing. So why didn't the markets go up substantially with all these great releases on earnings? Because of the growth factor. It's more important to understand what the growth is for the reasons that I just showed you. And so now I ask you, why is Buffett getting out of Apple? Is it because, do you think the world's greatest investor understands this formula? Of course he does. You think he needs all of these hundreds of billions of dollars to pay his taxes? Of course not. Of course not. He's getting out because he understands growth is slowing, and that's going to be a problem. And if you want to exit your business, this applies to you. So as an investor, understand growth. Growth is really a hugely important thing. Don't just look at historical earnings. Listen to the company releases, to the analyst calls. Listen for growth. That's a very important factor in a stat if you want to buy value as opposed to momentum. And if you own a business and you want to exit someday and become independent and wealthy, which only 2% of new businesses ever do, think about, in your strategic plan, think about sustainable growth that is demonstrable and transferable to a third party purchaser. Now, I'm already over time. I want to talk about why Berkshire is getting liquid, because we only have one more sleep until the election. I mean, how exciting is that? And I think that they think that the whole world's going to go to crap after the election, after Kamala becomes president. I certainly think that. And it's good to be flexible. It's good to be in cash, hunkered down, working away. And I think that's what they're doing at Berkshire. I am out of time. I want to talk about the accounting side. I'm going to talk about that tomorrow. And when I do, I'm going to talk about how Sinclair Range can help you and your medium and small business with fractional CFO, fractional controller, and bookkeeping services. It's a cool product for us. It's going really, really well. So I do want to talk about that. Thank you for joining me. I will be on the road the rest of the week. So sometimes I might have technology failures. That often happens when I'm traveling. But apart from that, I will be here the rest of the week, 8:30 Mountain Time, 10:30 Eastern. Thank you for joining the live stream. We will see you tomorrow.